Good evening and welcome to our October London South East and focusIR Natural Resources webinar. For those of you who don't know me, I am Donald Leggett, Head of IR Media at focusIR, and I'm your host for this evening. We're delighted to welcome four excellent speakers tonight, loosely connected by two main themes, oil and gas and battery metals. So, are we seeing a renaissance in the oil and gas sector as the transition to gas continues? And battery materials, if we need 100 new graphite mines to feed future demand, where will all that new graphite come from? Presumably, at least part of the solution to the supply chain crisis lies with the circular economy. Will battery recycling fill at least part of the supply chain gap? We will explore all these fascinating topics tonight, and hopefully our featured companies have some of the answers. Firstly, Will Holland, CEO at Europa Oil Gas, and they are an AIM-listed oil and gas producer, explorer and developer. We have Stefan Bernstein, CEO at GreenRoc Mining, the AIM-listed Greenland-focused developer of critical minerals. These include graphite for EV batteries and titanium. And Jeremy McManus, General Manager at Neometals, the ASX and AIM-listed recycler, will be joining us live from Australia. Neometals have three different and very interesting JVs progressing right now, including a recycling plant they're building for Mercedes. Finally, we're joined by Gaius King, a hugely experienced commodities analyst from Fox-Davies Capital. Gaius is running his eye over the oil and gas sector for us tonight. He believes demand for gas and oil will grow for many years to come. It hasn't reached peak yet. It underpins the global economy after all. And he also thinks the UK is overtaxing North Sea producers. Each presenter has 30 minutes or so to speak, with 20 minutes to make their investment case before we take your questions and put them to the speakers. Some brief housekeeping points for you. Some of you have been asking if I have a new employer. We have rebranded, and focusIR is now the new name for London South East's Digital Investor Relations Division. We continue to use the London South East website to distribute our content. There's more of it now these days, and we work independent from, as well as alongside existing corporate advisors to provide investors with all the key information they need. So there you have it. As ever, many thanks for joining us tonight, and it's time to hear from our four speakers. Europa Oil Gas is an AIM-listed UK and Ireland focused oil and gas exploration, development and production company with a portfolio of gas and oil assets including Wressell, Cloughton and Inishkea. Average production for them is around 268 barrels of oil per day, which covers operating costs. Europa announced positive news from Inishkea West yesterday, with gas reserves up 92% to 1.55 trillion cubic feet of gas, which could indeed be a game changer for the company. Here's CEO Will Holland from Ireland, very appropriately, to tell us more about the portfolio.
Oh, good to be here. Thank you very much for having me. And yes, you rightly say I'm here in Dublin tonight for the Energy Island event, which is being hosted by the Minister for Energy, Eamon Ryan. So I'm looking forward to talking with him later on this evening about our Irish opportunity. But let me go through the whole portfolio for you. Usual disclaimer we have there. I shall let people read that from on your website at a later date in their own leisure. So what is Europa? We're AIM listed. We're a small cap. We have three different types of assets. We believe we have a good balanced portfolio of assets, and they consist of cash generating production assets. They more than cover our G&A. Actually, we generate profit from that, which means our bank balance is growing. I'll talk a little bit about those assets, and then we have some appraisal assets, which include Cloughton, which we've recently become operator of, and we think is a very, very exciting asset with lots of potential, as well as our Serenity asset offshore UK. And then we have some very significant blue sky exploration potential offshore Ireland. And that's where we announced yesterday a very exciting development with regards to the seismic reprocessing that we've just completed the first stage of. And then added to all of that, we've got a good balance sheet, with a very strong balance sheet, over £5 million of cash, no debt. And as I said, the assets do generate income above what our G&A is, so the bank balance is building. The results here are from our half-year results, and our end of year is 31st of July, and we will be announcing our end of year results shortly. I think the important point to note as I'm going through this is that we are fully funded. So we are not. When I go through our portfolio, investors should bear in mind that we're not looking to raise money in the future under the current asset portfolio. So let me just go through them. Onshore UK. Here it shows our 5 assets onshore UK. 4 of them are producing oil. Wrestle, I'll talk about in a bit more detail. Crosby Warren and West Fursby are late life assets. They're long tail production, and they are pumping away quite happily, along with Wisby, which we have actually a royalty interest. We're not on the license there. We're a royalty holder. And then there's Cloughton up near Scarborough, which is a discovered gas field onshore, which we think has got some very exciting development potential if we can prove that the well will flow at commercial rates. So let me just go through each of these assets. So on the screen here, this is a simplified map of the trend that goes up from the Briggle discovery up to Crosby Warren. Crosby Warren is our field. We're producing that. It's all very close to the grey area to the far left is Scunthorpe, which is where British Steel have got a large facility. And in the middle is Wrestle. Wrestle is currently a single well development. We're currently installing a jet pump into it. It's been producing very, very happily for the last couple of years. We've produced almost 500,000 barrels. We think there's probably another 500,000 or so to go. And we're planning to drill another, with our partner Egdon, planning to drill another development well into the Wrestle horizon. And then above Wrestle, we've got the Penistone horizon, which is a more gassy horizon, and we're planning on drilling 2 development wells into the Penistone horizon. This will all happen over the course of the next 18 months, and we're just going through that process to get all the necessary permits and secure the rigs, and hopefully we shall be drilling this next year. So that's exciting. It'll be utilising the existing Wrestle 1 pad, and yes, the key thing to note about the Penistone horizon, though, is that this is a more gassy horizon. So we're looking to connect to a local gas pipeline to monetize the gas that'll be produced with the Penistone. Also, there is gas associated with the Ashover horizon, which is the current production horizon that we're doing. We are in the process of producing a CPR with ERC. It's been a bit delayed, but hopefully we will be in a position to announce that in the coming weeks. So Cloughton is this asset we announced a few weeks ago that we'd taken over operatorship of this. This was a field that was Egdon were operator on it. They're also our partner on Wrestle. So we have the same partners on Wrestle as we do on Cloughton, and it was decided that we were in a good position to pick it up and actually develop this asset and test it. So this is a large onshore gas field. It was drilled in the 80s, and it did test gas. Now it tested gas at sub-commercial rates at 28,000 cubic feet per day. So it's that rate it's sub-commercial, but it's a very large column of gas, and we think that when it was tested, it wasn't done optimally, and that actually if the well was completed correctly, how you would complete it today, that we think we could get up to 6 million standard cubic feet of gas out of it. Now that is very commercial. We haven't actually announced what we believe the value of this resource is, because we're going through a an economic analysis of it, modeling what we think it would produce under a development scenario. But the key thing here, and what we have highlighted to many of in our press release, is actually getting the stakeholder consents that we need to be able to drill here. We are close to the North Yorkshire Moors, and so we need to make sure that we get buy-in from all of the various stakeholders before we really start spending any money on that. We do think that we will get that buy-in, and we've got support from the landowner to start this development. We also need to get the support from the North Yorkshire Moors Authority for planning, and then the EA as well. We're in the process of doing that, and once we get that, we will be looking to do some seismic. First of all, because the seismic's a little bit loose, so we'd want to shoot some seismic over it, and then we'd be looking to twin the existing well and prove that we can get commercial rates out of it. So plenty of news flow with that. It's completely in line with the government strategy for energy security, as is all of our opportunities, all of our assets. They're all looking at domestic supply of hydrocarbons as opposed to exporting them anywhere. So exciting potential with this asset, very sweet gas as well. So plenty of news to come on that. Offshore UK, we farmed into this field, farmed into the i3 operated field. The original well was discovered. If you look on the slide here, it says the discovery well, the S1 well, was drilled and discovered oil in the Captain Sands. We farmed in to drill an appraisal well. You can see there in the middle of the structure. The risk here was always whether the sand was going to be, whether oil-bearing sand was going to be present. Unfortunately, we didn't find oil-bearing sand, which was a great disappointment. But what it did do is it provided us with data that allowed us to recalibrate our subsurface model. And we now believe that the field is connected to Tane, which is adjacent to it. And you can see the Tane field to the right of the original discovery well. So we're now looking at ways of monetizing this and bringing it online. There's existing infrastructure surrounding this, and we are engaged with the various parties about how we can develop this field. We believe that the in-place volumes are between 10 to 20 million barrels. So it would be a single well for Serenity, but in a unitized development with Tane, then we'll be looking at multiple wells there. Hope to be able to announce more on that in the near future. Now, Ireland is what I really wanted to talk about because that's what the recent news was, and we put out this yesterday, in fact. So for those that aren't aware, Ireland has one gas producing asset, which is the Corrib field, and here you can see it on the map. It's got an 85-kilometre pipeline to the Ballineboy gas terminal, which connects to the infrastructure. So Corrib supplies about 20-25% of Ireland's gas. The rest of it comes from the UK. So they do not have a particularly good security of supply, and Corrib is, by our estimates, probably run out in the next 5 to maybe 10 years. So we're adjacent to it. Our prospects are sort of 10, 15 kilometers away from the existing Corrib infrastructure. And when Corrib was drilled and developed, the subsea manifold was put in place. It was designed to have other fields tied back to it. So there's capacity, there's plenty of capacity in that pipeline. There's plenty of capacity in the Ballineboy gas terminal. And this is the lowest emission gas which Ireland could produce and could consume. So from an environmental standpoint, Ireland has ongoing demand. This is the cleanest gas they could possibly develop. So what's changed? Well, for those of you that remember our previous presentations, we had two prospects, Inishkea and Inishkea West. We've reprocessed the seismic. Now, there's some volcanics and some shallow volcanics which had made the seismic slightly difficult to interpret. Seismic reprocessing is continuously improving. And the reprocessing that we did was full waveform inversion and reverse time migration. And that has really improved the quality of the subsurface imaging that we see from the seismic. And when we were farming this out originally, Inishkea, which we believe was a 1.5 TCF prospect, the risk there was a side seal risk. It was a three-way closure against a fault, and the seismic showed that actually that fault seal probably isn't good, and that reduced the size of Inishkea. And when I first heard this, my heart absolutely sunk, to be honest with you. And then, but then as the technical team were talking me through it, we said, well hang on a second. Inishkea West has now grown in size materially, because originally that was below a TCF. We're now looking at that as being 1.5 TCF. Now, the key difference with Inishkea West is that this is not a fault sealing closure. This is a full-way closure, so it does not rely on a fault to contain the gas. It's got a salt seal over the top of it. So it's a much better seal. It's a lower risk seal as a result. In addition, Inishkea West is 900 meters shallower than Inishkea, which means that the reservoir quality will be better as well. So it's higher, it's structurally higher up. The well cost will be lower. The recovery of gas per well will be better. So we've ended up on our license with the same size prospect. It's a different prospect. It's one that we knew was there, but it's now bigger than we thought. It's 92% bigger than we originally thought. So it's the same size as what we thought Inishkea was, at 1.5 TCF. But it's going to take less wells to develop. It's got a higher chance of success. So the economics are going to be even more robust. Now, we're still going through that economic analysis, and we will announce those results in due course. But from a farm-in perspective, this is a much more attractive proposition than what it was in the past, because of those key points that I've highlighted, i.e. Lower risk, better structure, less uncertainty around the default, because there isn't a requirement for default, still close to Corrib, and better quality reservoirs, so better recovery rates. So all in all, we're very encouraged by these results. Now, it doesn't mean that Inishkea, we couldn't develop that. As you can see, we've still got a prospect there. It's just smaller. And also, I'll point out, we've got Corrib North, which is on our license, which is also a discovery. And that could also be potentially monetized as we tie back to the Corrib infrastructure. So very exciting time for us here. And we also announced we're now applying for an extension to the license, because the reprocessing that we've done, we believe there's a little bit more reprocessing that we can do. Now, we don't think that's going to materially change the volumes, but it could improve the subsurface imaging. And we believe that a farmer would want to see that work done as well. So that's something which we are going to do. So very exciting times for Ireland as well. Now, I talked to you earlier on about the requirement for gas in Ireland. This chart here shows Ireland's this is government data showing what they forecast their gas demand to be. There it shows Corrib production, and you can see Corrib gas tailing off, and you can see Inishkea. This is our initial Inishkea West production profiles. I actually think these are very conservative, and we would more than likely be filling the Ballinabboy terminal to capacity. So this is a great solution for Ireland. They have ambitions to become a renewable energy state, but in the meantime, they need gas, and the government is forecasting that they need gas, and this is the best solution for them, as far as I'm concerned, and a lot of the ministers in Ireland agree with me on that as well. I recognise I'm running out of time. This is the team. We're all very experienced oil and gas people. Brian, our chairman, Simon and Stephen, we're all, and then also Alistair, our COO. We've all been in the sector for a long time. We are also looking at new opportunities, and we constantly look at new opportunities, but we're very value focused. We don't pick up assets for the sake of picking up assets. They've got to make sense. They've got to be something which fits our skill set, fits us as a company, and we're very protective over our cash, and we want to make sure that we operate within our means without having to come back to the market to raise more money. There are balance sheets from the half year. As I said, we're going to be doing our full year will be announced very shortly. And ESG, our approach is domestic hydrocarbons. We think that's the sensible thing to do. We are good custodians of hydrocarbons, and that's a core philosophy within the business as we progress. So I've had to skip through the last few slides quite quickly because I'm aware of running out of time. So that's it. Thank you very much, Donald, and I appreciate the opportunity.
Okay, that's fantastic. Thank you very much indeed. It might be useful for me to pick up on quite a few points which come out of your discussion there. The farm out, when might the Inishkea farm out process be restarted? I think if that's the right way of phrasing it.
Yes, yeah, absolutely. So we have put it on pause. We put it on pause because the license the current phase one of the license expires at the end of January, and we have to notify the regulator within 3 months before it expires of what our intention is. So that's the end of this month. Now we know there's more reprocessing that we can do, and we're still engaged with the companies that are interested in farming into the license, and we know they want to see that. So we believe that we have a very compelling case, and we have applied for an extension, or we're in the process of applying for an extension. We haven't actually lodged it yet, but we'll be lodging it later this week, and we would expect to get that before the license expires at the end of January. As soon as that happens, we then reprocess the seismic to 30 hertz. We reprocessed it to 10 hertz and then 20 hertz. So we will be reprocessing to 30 hertz. Once that's complete, which will take a few months, we'd then kick off with the farm out campaign again. So that's going to be early next year.
Does it take a lot of money to reprocess, or is it simply quite literally a process? It just takes time.
It does take money. It's it's quite complicated work. We use a company called DUG, DUG, which is a specialist seismic reprocessing, and it costs for the next round it'll be several £100,000 to reprocess. So it is a material amount of work.
But money well spent.
Money very well spent, yes, because it does really improve the clarity of the seismic.
Okay, and carrying on from that, Neil Brown asks, what's the geological chances of success for Inishkea West following your recent reprocessing exercise? Thank you. So there you go, Neil.
A very good question, and that's something we are still working up. Now, we had Inishkea as a 1 in 4 chance of success. We believe this is that Inishkea West is given the reprocessed seismic. We think that's going to improve. So we're probably looking at something like a 1 in 3 chance of success. But we haven't completed that work yet. But that's what I would hope that it will come out at.
Great. My second question for you was what are the next steps for Inishkea West? But we've kind of been through all those, haven't we? So let's jump on to the third question, I think. You're at an as you referenced, you're at an oil and gas event in Ireland tonight. Are you expecting some interest? And who will you be lobbying in the government?
Well, so it's an energy island event, and so there's going to be people from all different parts of the energy sector. So that includes renewables, sort of biofuels, as well as the hydrocarbon industry. There's not much choice left in Ireland now from a gas security of supply. As I showed from that chart earlier on, there's undoubtedly demand in Ireland going forward and for the foreseeable future. So Ireland has a choice to make. How do they satisfy that gas demand? Now they've already rejected putting LNG, an LNG regasification terminal in the Shannon estuary, because the minister, Eamon Ryan, believed that there was a good chance that they would end up importing gas from the US, which is fracked gas, and they don't want to do that. They have a policy of not importing fracked gas. So if you want to follow that policy, and they're importing gas from the UK, as many people will know, gas in the Southern Gas Basin, very often the wells are fracked there. It's been perfectly normal and part of the development of many fields like Clipper South and other fields in the Southern Gas Basin. So it's slightly strange that they think that if they're importing gas from the UK, that it's not frack gas, because some of it is. But if they really want to adopt that policy, then the best place for it is their domestic gas, which is what we offer. Now, they're not prepared to issue new licenses. Ours isn't a new license, and we can travel through the various phases of our license and drill the exploration well, develop it. That's all permitted under the current Irish legislation and current Irish policy. The people who are going to be at the conference tonight are going to, the Minister, Eamon Ryan, is here. We'll be talking to him, but there are also people from his office, and I'm actually meeting some of those tomorrow morning to talk to them directly about this. They're aware of it already, but I think part of it is just to update them about the work that we've done and how it reduces the risk and how this does just make perfect sense for Ireland. We can drill this. What we need really is for the Irish government to start messaging that they would welcome foreign direct investment into the country to help explore for more gas. That's what we need.
Okay, Michael Isherwood, I think he's a long-term shareholder. He says, Will, congrats on the Inishkea West new prospective resources number. 2 questions from me. Firstly, a lot of long-term shareholders are heavily underwater. What encouragement can you give them? That's his first question.
Well, good to hear from Michael again, and thank you for being a loyal shareholder. As I mentioned during my presentation, we're very value driven, and we are very aware that we have cash, we have a cash generating asset, and we have to be very careful on how we deploy that cash. Now, Michael, I don't know how long he's held his shares for, but the company it's been on the exchange for a long time, over 20 years, and in that time the company has issued shares. We don't have any intention of doing that. We have an income stream. We look after that, and we deploy the capital very as sensibly and as carefully as we can. But we are looking for value-driven events, and I think Cloughton is a very great example of that. We can test a very substantial gas prospect onshore UK, which can be developed at a relatively low cost. And we can do that without raising more money. We can do that with our partners, Egdon, who are now a private company backed by the Hayco Group, a well-funded Texan organization. And so we're very conscious on driving value and not diluting shareholders unless we see a really good opportunity and then the risk reward is compelling. I come from an investment background, so I used to invest in companies, in upstream oil and gas companies. I'm an upstream oil and gas guy, so I'm very conscious of preserving shareholder value and deploying our capital in the most responsible way that we possibly can.
And his second question flows quite directly into that. You've partly answered it already. Can you provide some colour on the board's strategy for growth beyond Ireland and beyond Wrestle? And will the board be prudent with the shareholders' capital? Well, I've heard you say at least 3 times that you will be, so yeah, I'll take you at face value on that one, Will.
Yes, I mean, Wrestle development, we've got a very exciting Wrestle development that will cost some money, but the risk reward there is excellent. The barrels that we produce and the gas that we produce out of the UK is very valuable. The operating costs are low, so it will end up becoming a very strong generator of cash flow, which we can then use to develop Cloughton. We're going to test Cloughton in the most cost-effective way that we possibly can. I'm not going to go into details of that yet. We hope to announce some more details to the market in due course. And then we're looking to get a partner into Ireland to help pay to test and then develop any discovery that we make offshore Ireland. So we're not looking at issuing more shares.
You've told us about Wrestle, you've told us about Penistone, and now you're not talking about wells on Cloughton. How will you plan to sort of phase those so that you can actually afford them all, and in terms of management time as to how it would all work?
Yeah, very, very, very good question. Because I mean, if we did everything in one go, we wouldn't have sufficient cash. But so it's all about phasing. It's all about making sure that we time things correctly. Investors will know Agden are our partners on Wrestle. They're also our partners on Clausen, and so they're also very aware of this. And we have a very good working relationship with them. We actually do contribute a lot to the Wrestle development program and phasing that in an appropriate manner to make sure that we don't run out of cash as we're developing it is a key part of that. And so they're working closely with partners to optimize our cash is paramount in our thinking.
Okay, final question. What are your thoughts on the UK's energy strategy as it affects Europa onshore in the UK and offshore in the North Sea? And do you ever wish you operated in the Norwegian sector of the North Sea? I just have to ask you that.
Well, the UK political environment, as everyone knows, it changes rapidly. But a lot of people are concerned about a potential Labour government coming in. I'm actually not as concerned as others. I think Labour are probably, I know some people who are quite close to the Labour Party, and they recognise that the oil and gas industry is actually something which they should be supporting, and actually they do quietly support because it does generate jobs, it does generate taxes, particularly up in the north of England. And Wrestle, Cloughton fit firmly into that. And they also recognize that domestic hydrocarbons makes perfect sense. Why would we be importing hydrocarbons? We're still using the things. We've got a natural resource, let's use it. And I think both governments recognize that. The Labour government now probably wishes that they had announced something before Rishi Sunak did, but I'm not overly concerned if a Labour government does come in power, because I think the qualities of onshore UK development fit firmly into what Labour supports.
Okay, let's draw a line under that discussion. Will Holland, CEO at Europa Oil and Gas, that was a fantastic presentation. Thank you so much for joining us. GreenRoc Mining is AIM listed, and its main focus is the development of the Amitsoq graphite project in Southern Greenland, which has a JORC resource of 23 million tonnes at a grade of 20.41% carbon, making it one of the highest grade graphite deposits in the world. GreenRoc aims to provide the European market with high quality graphite for use in the manufacture of electric vehicles batteries, which contain more graphite by weight than any other raw materials. Stefan Bernstein, CEO of GreenRoc, joins us tonight to explain why Amitsoq is well positioned to support and benefit from the race for net zero. Welcome, Stefan.
Thank you, Donald. And so graphite is really a vital raw material for the energy transition. And at Amitsoq in South Greenland, GreenRoc Mining has a large deposit with world-class grades. And we are currently developing that towards production. And so what I'll be presenting today to you is the details of this project, and also present to you the reason why GreenRoc is a great investment case. Right, let me just see if I can switch the slides here, get through the disclaimers. So GreenRoc Mining has assets solely in Greenland. Amitsoq is the most advanced of our projects. It's lying in the southern tip of Greenland, and therefore we are presently putting all our resources towards forwarding that project. We are listed on AIM in London under the ticker GROC. Our share price was yesterday of 4.25 and the market cap at around 6.2 million pounds. So in this presentation, I'll first describe to you why graphite is such a vital raw material, and then go on to explain to you what it is we have in the ground in Greenland, what it is we are developing, something about the processing of graphite, which is not trivial, and then on to some news concerning the European Union, Europe, and Greenland, and then finally ending with the roadmap to production. So graphite. Well, graphite is used in anodes of most of the current day modern batteries, particularly the lithium-based batteries. So it is graphite that makes up more than a fifth of the battery weight. And that translates into electric car batteries, typically containing about 60 kilograms, if not more, graphite. And the graphite that is being used to produce the anodes in electric vehicle batteries has to be processed into what's called spherical graphite. So in the lower panel there, you see natural flake graphite as it comes out of the ground after it's been refined. Then it has to be processed into this coated spherical purified graphite, which you see to the right, these small potato-shaped particles. China is sitting on the largest part of the world's production. More than 60% of world's production of graphite takes place in China, and all of the processing. That means that the battery industry that is developing today in Europe relies fully on supply of this spherical graphite from China. Right, so another important aspect of graphite is that it cannot easily be recycled. That means that the graphite that is being used in the electric vehicles today, in 10 years' time or so, when the batteries are being recycled, you can take out the copper, the nickel, the cobalt, and so forth, and reuse it. Well, graphite has some physical properties that are very well defined and meet some strict specifications. So while it can be recycled into the use of the steel industry, for instance, it cannot be used as battery-grade graphite again. That means that the demand for graphite is going to continue to rise in the years to come. So the graphite anode supply chain looks like this. In the white bar there, you have the mining, where you take the graphite ore out of the ground, you process it into graphite concentrate, which is then undergoing a processing, quite advanced processing that involves micronization, classification, spheronization, purification, and coating before it eventually ends up as anode-ready material. So our business is to set up production of graphite from our deposit in Greenland, ship that concentrate into a processing plant that we are setting up in Northern Europe to provide the industry with anode material. The market for the anode material is fast and growing. Across Europe, by 2030, that is in only 7 years' time, there'll be more than 40 so-called gigafactories in production. They will have a capacity of nearly 1 terawatt hour, which in turn demands more than 1 million tons of graphite. And what you can see is also, like in the upper right-hand side panel, you can see the global demand for graphite is set to rise by 400% in the coming decade. And therefore also the prices of anode materials is set to rise correspondingly over the next 10 years, as forecasted by, in this case, Fast Market in the middle panel. So on to what we have in Greenland, Amitsoq. It is a world-class deposit. It's sitting on the southern tip of the long island you see in the satellite image to the right at the red diamond. It is surrounded by deep water fjords that provides access for ships year-round. It's ice-free year-round. It's about a little less than 20 kilometers northeast of the town of Nanortalik. And importantly, Amitsoq was a producing mine about 100 years ago. It closed in 1922, and that attests really to the high quality and the high grades of the ore. There are several satellite deposits nearby that have not been drilled, but have similarly high grades of graphite. and they are all under GreenRoc's license. We have conducted 2 stages of drilling and arrived at a resource of 23 million tons, as you can see in the table, with an average grade of more than 20% graphite. That is sufficient graphite to sustain mining for several decades. And that grade really puts us in the top league of projects under development worldwide, as you can see on the orange bars. Also important here is that the value of our company is presently very low compared to our peers. If you take the value of our company measured in terms of dollars per ton of market cap, expressed as dollars per ton of contained graphite resource, as you can see in the green bars, we come out as the lowest of our peers. So there's serious growth potential. A quick view and the ore bodies here. This is a view of the island towards the east. You can see 2 graphite ore bodies dipping towards you. A red one, the lower graphite layer, and the orange one is the upper graphite layer. Just to show you the consistency of the grades across here, and it's simple ore geometry, which makes for easy mining. So we have conducted a series of test work on the ore. We've taken the graphite ore samples of that and provided to ProGraphite, which is a German specialist lab that's conducted some test work for us, showing that it can easily be upgraded to graphite concentrate by simple flotation. And we have then taken that graphite concentrate, which we envisage will be our product from our mining operation in Greenland, and process it through the various stages of micronization and spheronization and purification and so forth, and we arrived at the beautifully looking spheronized graphite sample that you can see to the right, which has a purity of more than 99.97, which is certainly battery grade material. So we also benefit from the close proximity to Northern Europe. We have about 4 to 5 days of shipping time away from Northern Europe compared to present day delivery of graphite from China, which is more than 40 days. Certainly there are big African deposits also, but they're typically about 30 days of shipping away. There are certain other projects in Northern Europe under development at the moment, mostly in Scandinavia. One producing mine in northern Norway that is set to produce about 15,000 tons per year and not likely to produce a lot more than that. So the other ones are possibly coming on stream also in the next over the next decade. We have planned an annual mining rate of 400,000 tons. And at 20% graphite, that will yield about 80,000 tons of graphite concentrate per year. So across all these deposits, if they all come stream, we'll be able to deliver about 300,000 tons of graphite concentrate to the European market per year by 2030. And comparing that to the demand of over 1 million tons of graphite. I'll also mention that we have received a letter of support from the European Raw Materials Alliance, stating that our graphite resource is of global importance, and we strongly expect also that our project will become a so-called strategic project. And that is important because recently the European Commission proposed a Critical Raw Materials Act that states a series of critical raw materials as strategic, and one of them is natural graphite. And the proposal demands that at least 10% of the consumption in the EU has to come from domestic production, and at least 40% of the processing has to be taking place in the European Union or in Europe. And this Critical Raw Materials Act passed the European Parliament by overwhelming majority last month, and it's set to be agreed finally before Christmas. The European Raw Materials Alliance also issued a call for action recently here, stating more than 50 investment cases across Europe for supply of critical raw materials for the energy transition. There are only 2 graphite projects identified in this call for action, and one of them is GreenRoc Mining's project in Greenland. There's a series of interesting figures and numbers in that call for action that paints a picture here, and you can see this is just one example here that in addition to lithium, we can see a growth in demand that is very significant for graphite. For lithium is more than 13 times growth between 2020 and 2030. Second to that is graphite at 5.3, much higher than any of the other raw materials that goes into these batteries and high intensity magnets and so forth, such as nickel, cobalt, rare earth elements, and so forth. That kind of underlines or highlights the importance of graphite. Greenland is a great place to develop raw materials projects. It has a very well-regulated mining-friendly jurisdiction. It's so that the social impact assessment, environmental impact assessments, and impact benefit agreements are all embedded into the mining law. There's one door policy here, so you only deal with one authority. And you can basically tick all the boxes along as you develop your project, as long as you're following all these various guidelines. There's no real barrier for us to receive an exploitation permit. So the roadmap to production looks like this. We are basically developing our project along 2 streams here. One is the production of graphite from our mine in Greenland. That is the upper road here, where we this year 2023 got the resource definition. We are presently working on the preliminary economic assessment. The environmental and social impact assessments are ongoing, and we are presently also conducting a flotation of a bulk sample to provide us with graphite concentrate for further test work. And then it'll be following 24 with exploitation permitting, the PFS, onto DFS and start construction end of 25, construction year 26, with start production in 27. And parallel with that, we're developing the capacity to spherinize our graphite concentrate from Greenland. We are presently developing further test work. We are doing some electrochemical tests, and we expect to be embarking on a feasibility study shortly. And that will then end in a DFS pilot plant construction 25, and then on to construction 26. So that by the time the first shipment leaves Greenland with graphite concentrate from our mine, there will be a processing plant to receive this graphite concentrate and turn it into active anode material for the gigafactories. And the PA, this is my last slide, which we expect to be delivered this month, contains all the, well, it's basically a scoping study. It contains details of mining rates, mining methods, processing plants, power needs, and so forth. It also has an economical model with a cash flow model and so forth that has all the metrics for the project. And that will be the concluding slide of my presentation.
Okay, Stefan, thank you so much. That was absolutely fascinating. Thank you very much indeed. So what would the next steps be for Amitsoq? Talk me through the next 6 to 9 months for Amitsoq as a project.
Right. So, firstly, we would like to conduct or collect another bulk sample, a larger bulk sample, probably in the order of 10 to 20 ton, because we have experienced quite a bit of interest for our product from various potential off-takers. So we basically exhausted the relatively small samples we started out with, and we need to provide them with material so they can do their own test work. So that'll be one thing. The next larger point in our work program would be to conduct a bit further drilling to constrain the resource further, possibly also expanding it, and some geotechnical drilling, which is required to conduct the pre-feasibility study, the PFS, which we expect to be carried out next fall.
And strategically, is it important to actually build your resource, or do you have sufficient as it stands? What's your thinking on that?
So I would say that presently we're quite happy that we got sufficient resource that we can start thinking about what a mine would look like here. That's basically why we are now conducting the PEA and can see that we, by this time next year, is embarking on the PFS. But of course, that is a jump from the PEA to the PFS. The PFS requires a bit more certainty and technical aspects of the ore that we can only achieve by geotechnical drilling.
Okay, let me ask you about potential investors and partners. You talked about offtake agreements and people coming for samples and supplies. So people have been approaching you. Talk us through that interest. That's absolutely fascinating.
Yes, that's of course important. With such a project here, graphite is unlike copper, for instance, where there's like a spot market. Graphite is usually sold on contracts, and therefore you need to know your customer and you need to know the specifications of the requirements. And they are very strict because the batteries have certain, of course, requirements. I would say that when we started more seriously to talk with potential off-takers last year, in the beginning, I wouldn't say it was difficult to find them and get their attention, but it was not until we announced a new resource here that people start realizing how big this deposit really is. And they were interested also after we could demonstrate that the graphite ore can be turned into the spherical graphite, that they started to be asking for a sample of the material. So we have now sent material to some potential off-takers. It's come back quite positive, so it certainly lives up to the expectations. But we need to send more material because they like to conduct further test work, and you also need to prove eventually, which is some years from now, that you can deliver consistent quantity over some time and also in amounts that fulfill their needs. So that's why we need to build at some point a pilot processing plant.
Is that the spheronization plant you were talking about?
Yes, it is. That is not standard.
Tell us as much about that as you possibly can, please, Stefan. I understand that some of it may be work in progress, but just tell us what your thinking is on that spheronization plant. It's going to be in Northern Europe. Where might it be in Northern Europe? Just tell me any detail you can about it.
Yes, so today, if we were to process our graphite into anode material, we'll have to ship it to China. There is no such processing plant in Europe. So obviously there's a lot of development work that needs to be done, but we have very good consultants that help us out with this. So the feasibility study will not only look at state-of-the-art processing techniques that are available in China, and you can purchase these spheronization units on Alibaba and other platforms. It's certainly possible to set up such a processing plant. Other companies have started doing that. There's one in Australia, there's one in North America, in the US. So it's certainly possible to go that route. But we are also interested in looking at what European manufacturers of spheronization equipment can provide us with. There are 3 German manufacturers of spheronization equipment that are developing units for processing of graphite. And we are currently speaking to all 3 of them in terms of what they can produce, the quality of the material that they can yield, and also, which is very important, the recovery, you can say, because the Chinese are very good at processing into high quality spherical graphite, but they lose a lot of material under that way. So typically the yield is only, say, 40-50% of the graphite concentrate you put in, whereas some of the European manufacturers at least indicate that we can achieve between 60 and 70% yield, which is of course saving a lot of material. Mm-hmm. So those are the things that we are presently studying in much greater detail, and the feasibility study that we'll be conducting will set up a variety of possibilities. What are the costs? What are the energy requirements? What are the yield? What purification process should we go? The hydrofluoric acid route? Should we go through the caustic fusion route, and so forth? So there's that will be. It's a bit of a. I would say it's more advanced than setting up a processing plant and a mine, because that's much more standard. But on the other hand, we know what we want to achieve in the end, and we have several options. So it will take some time, but it's certainly a great upside to be able to produce spherical graphite, so we have a virtually integrated production of anode material.
Okay, my last question comes from Dr. Mark Schneider. He's asked several questions, with many apologies, Mark. We're not going to answer them all, unfortunately. But in terms of, you've asked several interesting questions. How big is the GROC team, Stefan? And when are you planning to hire, and for what positions? Presumably with so much work, so much expansion, feasibility study, so on and so forth, you will need a team to do it. What are your thoughts on staffing?
Yes, so we have a great team at GreenRoc Mining. Across the board, we have a broad range of expertises. I'm a geologist by training. I've worked with Greenland all my life. And then, of course, as the board, we have several other expertises. Obviously, when it comes to more specific work we want to conduct, we have allied ourselves with some very senior consultants that provides us with a lot of good work. But we are also currently considering expanding. We are presently doing some hiring, which I can't reveal exactly what it is about, but certainly particularly looking into this processing plant. That is much more work that we can conduct, of course, just across the board and through the use of consultants.
Stefan, that's absolutely terrific. I'm going to end it there. Thank you so much. I appreciate there's a lot of things that are sub judice. You can't actually talk about everything. Things are commercially sensitive. I really appreciate you for coming on and being as open as you have been. It's been a real pleasure to have you on tonight. Thank you so much. Okay, moving on to New Metals. New Metals is a leading provider of innovative recycling solutions, supplying recycled materials to the battery metals industry. Yes, there's a theme tonight. It's listed in Australia on the ASX and London on AIM, with a market cap currently of £102 million. The company has developed a suite of battery metals processing technologies that reduce reliance on traditional mining and processing. New Metals currently has 3 battery metals JVs, all commercializing proprietary, low-cost, low-carbon process technologies in incorporated joint ventures with a clear pathway to profitability. We're joined from Perth, Australia tonight by Jeremy McManus, and he's the General Manager at New Metals. Welcome, Jeremy.
Duncan, thank you for the introduction, and look, thanks everyone for your interest. So what I'm hoping to do is, we're listed on the ASX and also on AIM. We're flying under the radar a little bit on AIM, so it's a pleasure to give you an overview more generally of the business, but then I'm going to dive down specifically on how we're building a world-leading lithium battery recycling solution, and we're doing it in Europe to start with. Now, let's make sure these slides are moving for me. So I've got a bit of a standard disclaimer here, but maybe some context around me. I'm a general manager for Near Metals. I'm tasked with looking after, amongst other things, the investor relations function, but my career's been in and around minerals and materials for the entire time. That's fortuitous, shares some parallels with what Near Metals is actually doing. And, we heard from a graphite upstream story just before this. So we share some parallels, but unlike a single commodity deposit, we're looking to pursue multiple materials which we're extracting out of feedstocks that are above the ground. So there's no mining risk. It's an urban mining opportunity, if you like. And so, look, diving into this, what Near Metals has done is we've developed a suite of mineral processing technologies over the journey. Those technologies underpin the three business units you can see in that diagram on the right-hand side. And with those technologies, we're applying those in order to recycle materials from batteries, as it were. We're looking to recover materials and to downstream process. So, really there's four things about the business that I want to highlight. The first being that we're enabling the production of sustainable materials and, supporting that transition to a circular economy. Two, in chasing, carbon benefits, if you like, through R&D, we've managed to really drag down our operating costs. Three, we've got tier one customers, the likes of Mercedes and some very strong partners. And then number four, we've got, and this is a real key distinguishing factor about our business, is very flexible business models where we're targeting technology licensing and a royalty business model. So if I look really quickly at those four things, so I talk to sustainability. We're very much walking the talk in this regard. So not only are we looking to produce materials that, make green applications, but the way we're doing it through the R&D and our processing technologies, really underpins the sustainability of what we're doing. We've got some accolades on the right-hand side there. Best technology in the AIM Awards in 22 and secured the Green Economy mark. So we're also getting some ESG ratings starting to filter through, which is nice. The second thing I mentioned to you, and this probably relates to sustainability still, is this whole drive towards net zero, if you like, is pushing for more and more battery materials. The image on the left-hand side shows you there's going to be deficits in the future. That this image on the left, battery gigafactory capacity, which just means more batteries are to be made. With that, there's going to be more cells, there's going to be more production scrap and more end-of-life batteries that need to find a home. And in chasing these technologies, the image on the right just shows you we've got this broad exposure to the key metals of the energy transition. So, 5 of those key 6 we speak for, and in fact 4 of them come from a recycling project alone. Operating cost and carbon advantages, I mentioned those. On the left-hand side, what you're looking at there is an image showing you all of our costs over the amount of lithium that we produce, just as an example. And when you look at it like that, we're in the lowest cost quartile, about $27 per unit of LCE, and that's quite extraordinary. On the left-hand side, it's just giving you a bit of a representation about the carbon that we can save. Because if you generate raw materials from a mine, if you can see my cursor, you've got this bigger bar with virgin raw materials. If you generate those same materials from recycling an old battery, for example, you're going to save, circa 70% of your embedded CO2. And this is really significant for, say, a car manufacturer that needs to make their vehicle greener, particularly for the second round of cars they make, or in fact the batteries that they're making to put in those cars. And then lastly, flexible business models here. We're happy to act as principal. We're happy to act in partnership, but ideally we're looking to supply plant packages and license the technology for royalty income. And that particular business model has allowed us to attract some pretty significant partners and customers. So these three pillars on the left-hand side is our recycling business unit. I'll talk more to this, but obviously we've got Mercedes and Steel Company of Canada as customers. To the right here, vanadium recovery is our second business unit. That's all about pulling vanadium out of steel waste. That waste for our initial project is to come from SSAB, a big Scandinavian steelmaker. The offtake's going to Glencore, who everybody knows. And then the third project, and I'm going to park these two and concentrate on recycling in a second, is our lithium chemical business. It's a joint venture with a very big Aussie company called Mineral Resources. And together we're looking to joint venture with Portugal's largest chemical conglomerate. So again, using one of our technologies to produce battery raw materials and do it in a very green fashion. So look, I'll dive now into the battery recycling. This has been a 7-year journey for Neometals. We've developed our technology initially for consumer electronic chemistries. That evolved. We redesigned the flow sheet for car batteries when we saw the sheer volume and the application of lithium ion coming on. And somewhere along the journey, we attracted the attention of a very big German company called SMS. We formed a 50-50 joint venture with SMS called Primobius. And so Primobius, the joint venture company, is solely responsible for the global rollout. And at the moment, we're at an inflection point there, starting to earn first revenues and, building an order book. So exciting times for Primobius. Just to give you a bit of background, why do we even bother considering recycling lithium batteries? And, there's a couple of reasons. Ignoring the fact that the batteries catch on fire often if you do nothing with them, ignoring the fact that you can't put them in landfill for the fact they're hazardous and that, the constituents are worth a lot of money. OEMs really need a sustainable supply of these battery materials going forward with a low carbon footprint. And recycling batteries is a fantastic way to generate those materials sustainably. So historically, OEMs, original equipment manufacturers, they never had to worry about the fuel that went in their combustion engine vehicles. That situation's changed now. The fuel for an electric vehicle, it is the lithium, which shuttles electrons around as you charge and discharge in the battery. The images that you're looking at, on the left, we're just trying to portray here the supply deficits that we're likely to see. So the big blue bar in the middle, that's demand for lithium units in 2030. Big demand, big shortfall in 2030 based on the supply that's available. It's predominantly coming from mine supply. The image on the right just shows you that towards about 2040, mine supply, which is where the materials come from for now, is going to be surpassed by recycled materials. And the majority of the demand is going to come, in this example, which focuses on lithium, will come from recycling in the future. So, look, one of the other reasons for recycling is it's a regulatory imperative. In Europe, the European battery regulations have just been passed into law. In the USA, it will follow. This is inevitable, this sort of regulation. It's a very important tailwind for both Neometals and Primobius. A little bit of a busy slide, but what it's telling you here is that through this regulation, you've got minimum recycling recovery rates, and they increase over time from 27 to 2031. So Primobius is achieving those based on our demonstration work to date, and I'll show you some pictures of that. But also the battery regs are saying that future battery cell production is going to need to be recycled content. That too will ratchet up. You need compulsory carbon footprints, etc. So these are phenomenal tailwinds for near metals, and they really enforce the fact that you need recycling going forward. And how do we actually do this? So the image on the left is a little schematic showing you the process that Near Metals developed and is now licensed to the Primobius joint venture. So it's a two-step process. You can take modules and cells of almost any denomination, if you like, but we're really targeting NMC chemistries in the vehicles and consumer electronics. You go through a three-stage process. First, you dismantle and you discharge the batteries. Two, the second stage is mechanical. We smash up, if you like, the batteries through shredding units. And what comes out then are the plastics, the steel casings, the foils that have the anode and the cathode on them. And we can sell those materials. If we owned the plants, we can sell those materials for money. If somebody else owns the plants and we're licensing the technology, they can either do the exact same or they stockpile the materials for their future need if they're making batteries or vehicles. What you generate through that first spoke step is a black mass intermediate. It's got all the valuable cathode materials in it, plus the graphite, which makes it black. And then we go through a hydromet recycling process to sequentially pull out the valuable stuff, the nickel, the cobalt, the manganese, the lithium, and we get left with the graphite material. And so on the right-hand side, what we're trying to show here is if you're a car maker, you've got two choices with regards to recycling, or three. One is you do it yourself, and that's complicated because these companies, they're trying to figure out raw materials and mining, which they never had to do. Now they're having to make their own batteries. And so recycling for many is probably a step too far. So their alternatives are to pay a merchant recycler who will take their batteries, buy them off them, and tick the recycling box. Or alternatively, you can use a company like ourselves. We're the only ones offering plant supply and technology licensing. And the benefit to doing that is we allow an OEM to keep their materials. They retain them, and as a result, they can see an economic benefit. They can turn a cost center from recycling, having to pay someone else, into a profit center. And that essentially is the business model for Primobius. The economics are really strong. The image on the left is a bit busy, so I'll let people look at that in due course. But on the right-hand side, we've done some cost studies for both the shredding spoke and the refining hub that I just mentioned in that diagram. And we've done it. This image shows you what the contained value of the constituents of these batteries looks like for the different chemistries. So if you cast your eyes to the bar on the far right, that's what the future holds with something called NMC 811. And our costs are just above $4,000 US. You can see the contained value there, is up around 9,000. So you've got about a $5,000 margin per ton, just to put that in context. So if you have, like our studies have shown, a 20,000 ton per annum plant, you're looking at making 100 million per annum profit, just to give you a broad idea. So what we do with the flexible business models that I mentioned is we're happy to act as principal, and in fact, we're doing it now in Germany. I'll show you some pictures in a second. We turned our demonstration facility into an actual commercial shredding operation. Very happy to act in partnership, particularly if our customer is big enough to justify sharing in the economics with the capex of the plants. But our preferred model is number 3, where we provide plant equipment packages and we license the technology to generate very stable royalty earnings. So, looking to build a portfolio, if you like. That's gone a bit mad, excuse me. So now to our partner. I talked about this 7-year journey. We drew the attention of the SMS Group, a very, very big private plant builder, 150-year-old, 14,000 employees. There's a ghost in the system moving my slides, but maybe my viewers can't actually see that jumping around. And look, they've got facilities in Europe, China, India, and where we've built our demonstration facility, you can see the images on the right-hand side. So that's Primobius, the plant in Germany. It's to the east of Dusseldorf. And the two pictures you can see are shredding spoke and also the refining hub. So the shredding spoke is a commercial operation, albeit small, 10 tonne per day, and the refining hub acts as a demo facility for R&D. So if we ever want to run customer trials, we can put them through the shredding spoke, through the refiner, and spit out products for qualification discussions, for example. So big group, we were happy to enter into a joint venture with them because we offer significant synergies to one another. So look, in terms of what we're targeting and why here, the image on the left shows you that the supply of batteries available for recycling globally is going to grow at a very fast rate. Initially, the smaller volumes come from processing scrap from factories, failed QA, QC, returns on the factory floor, but then the far bigger volumes are coming from end of life when the vehicles, dare I say it, have crashes, have warranty returns, or just naturally reach the end of their lives. On the right-hand side, that image shows you we designed our 20,000 tonne per annum plant, which is step one for us to round the scrap from a traditional gigafactory, like what they've done in Nevada with Tesla. But the bigger goal is to accommodate for the end-of-life batteries and have plants 10 times that size, which we're studying right now. So look, in terms of the customers and how we actually turn this into money. So our first customers is a decent one that everyone should have heard of, Mercedes-Benz. We have collaboration with Mercedes. It's a 5-year arrangement where our engineers will enter into their facilities. We are supplying the plant and equipment for a pilot facility in Copenhagen, Germany for Mercedes. We were just awarded the contract for the shredding spoke. Touch wood, very shortly we'll receive the same purchase order for the refining hub. And the reason this is so exciting, apart from the brand recognition and the validation that Merck provide, is that Mercedes, like other car companies, are going to be cell manufacturers themselves. So come 2040, if you cast your eyes to the right, Mercedes, which is not the biggest car maker, will have a recycling requirement of nearly 1 million tonnes per annum. So if you just pause for a second and think about the study that we did at 20,000 tonnes, this is 1 million tonnes for, not the biggest car company globally. And what that looks like is 5 of the big 200,000 tonne per annum plants, which I mentioned, or a very vast number of the 20,000 tonne per annum plants, which we've done a study on. So this is the end goal for us, to stay connected, do a good job for Mercedes, and get embedded. I mean, of course, we can't do everything for them globally, but we look to try and get a large share of that. So that's the prize. The second customer, where there's the opportunity for a future North American continental network, is with the Steel Company of Canada. And a steel company might sound like a strange customer and a partner, but Steel Company of Canada is transitioning to making more steel using electric arc, which is a lot greener than blast furnace. To do that, they need more scrap steel. Their feedstock comes from old vehicles, and increasingly in the future, those vehicles will come with lithium-ion batteries. So the partnership that we have, they're presently licensing our technology for a rollout in America with a view to many plants, a centralized hub and a network of spokes to smash up the batteries, neutralize the fire risk, and transport to the hubs. And they are already getting their steel from some very big North American car manufacturing names. So the idea is that in the future, they will have a recycling subsidiary. We have an option to enter the fray with them. And if we don't end up doing that and taking a joint venture stake, we will just continue with the license that we have on a 10% gross revenue royalty basis. So that's very exciting in North America. And that actually will be our first 20,000 tonne per annum plant. So I mentioned that we're growing a royalty portfolio, if you like. It's almost the recycling version of Franco-Nevada, if all things go well. The image shows you we've already got some existing licenses out there in Europe, all of which are based on a 10% gross revenue royalty. So this is exciting. We're looking to exploit the technology ourselves, but also with some licensees generating royalty revenue for us. And so that's already underway. And really what you're looking at for the recycling business unit is a very catalyst-rich timeline for us. On the far left, we've delivered on the hub economics. We put out this study, so now analysts have the ability to start to value us. And there's some folks in the UK writing research at present, the Royal Bank of Canada and Cenkos. That's worth a look to get a sense of how they feel and what assumptions they're making. But then going forward from here, we expect the purchase order for the Mercedes hub in the near future. We will then look to provide the plant and equipment for the spoke that we've just done the deal with Mercedes on. Look to do the very same thing with Stelco, but that plant will be, an order of magnitude bigger. That will be 50 tonnes per day. And then we roll it out like this: spoke first, hub second, Mercedes, Stelco, and then look to reveal who else is in our business pipeline, which is getting very full, and the order book is starting to get significant. So watch this space on our timeline and us delivering on some of those outcomes. And to cap off on Primobius, which is obviously one of 3 business units, we've got some pretty significant customers and partners, and that's part of the Neometals ethos, to work with partners to fast track things to get the scale right. And we've done it successfully in the past with our mining operations at Mount Marion. The economics for recycling are terrific. It's sort of a no question asked on the environmental credentials associated with that. Really big addressable market. We're exposed to a basket of battery metals. And I think the key thing here is we are different from the peer group, and there are others. It's not a winner takes all. We are not the only ones with a 2-stage sort of liquid-based solution to this. And the reason we do it is to get very high recoveries, which the world's demanding right now. But our business model is different. It's different for the fact that we're not just saying, you must work with us as a merchant and you pay us, or rather we pay you for batteries and then we keep the products. We're saying we're happy to be flexible, but we would like to deliver the plant and license the technology, and that will enable you as a customer to keep the raw materials. And that is critical for the OEMs and the cell makers, because if they're looking out 10 years, which they do as very large companies, they need absolute certainty over where the raw materials come from. And look, really, I'll just leave you with this. This is the Neometals highlights, because, of course, we didn't talk about the other 2 projects in detail, but, of course, the business is enabling this generation of sustainable battery materials. They're all going to be in short supply. Big addressable market, but we're looking to produce in the lowest cost quartile, really low carbon products. We have done this before working with partners. I mentioned Mount Marion. There are elements of that, even though it was an upstream operation, that we can apply as a cookie cutter. And we've got some very big validation from customers. So that's, hopefully I haven't run over time, but I wanted to give everyone a high level overview of what we're doing. It's the sort of story that's got a few moving parts, so we'd really welcome any inquiry, both now, Duncan, from any questions you've got, but obviously, we're listed, we've got a very detailed website, very welcome to reach out to us.
Gee, Jeremy, that was absolutely fantastic. I'm afraid you were so detailed, you answered just about every question I'd written down. So you packed a lot of information in. That was fantastic. Now let me just start again then, given that I don't have any questions. Where did that strategy evolve from? Because that's a very considered strategy. You've thought through that incredibly carefully. It's a big jump to go where the market's not, and yet that's you. You're unique. There's only you. Build plant, royalty streams, and then off you go. Where did that come from?
Yeah, look, it evolved for sure. I mean, we thought similarly to some of our peer group, if you like. I mean, they're not so much competitors because, as I mentioned, we really are the only ones offering these plant packages at this stage. But we quickly determined that what a lot of the OEMs want in the recycling world is often they need to show their stakeholders that they are taking an active measure themselves and looking after, their own requirements. But this criticality around sourcing raw materials and having absolute certainty, because if you pay someone to recycle, you will acquit your recycling responsibility, no question. You don't need to buy the plant, so that's no doubt attractive to some. But you don't have absolute certainty because these hydromet refineries, much like the base metal circuits for mining companies, they need to be fed all the time. You can't have days where they're shut down. You don't shut them down. So if there's a challenge with a merchant recycler needing to find feedstocks, which there will be because they're hotly sought after, then you have a challenge as an OEM and a risk. So we saw that and said, look, we want to satisfy what the customers need. Let's supply plant packages because actually our partner, that's what they do for a living, and that's half the reason we partnered with them, because being able to generate in-house the design and the plant packages was a big benefit for us and gives us some kudos in the market. So it evolved like that with recycling, but similarly, the other business units, the same applies really with a view to licensing technologies where it makes sense and where we can, and therefore start to generate some royalty income from multiple sources. So they're growth stories. It's like having a mine that has, more resource at depth, or, you're looking to acquire your neighbour's property, but we don't need to do that because the technology can be applied to multiple sites, for example, or technologies plural.
So, Jeremy, you think this actually it adapts very nicely to the OEM manufacturing model of just-in-time manufacturing?
Yeah, look, I think so, for sure. There's parallels. And our business model, understandably, there will be several recycling players, no doubt, having success. We need an industry. It's a very big addressable market. You can't have just one winner in this. And some people will want a merchant recycling solution. But it's worth mentioning also, we can sell plant packages to merchant recyclers as well. So I think we've got a foot in each camp, should we wish to. But for sure, I think this business model supports exactly where a lot of these big companies are going. And frankly, their strategies with regards how to get exposure to recycling, they're evolving too. I mean, they're big companies, but equally they've got a lot on their plates. They've got to figure out rocks now. They've got to figure out making batteries. It's all new. EVs are new. And there's a lot going on. So I think there's a very big space for companies like us who are doing a job of recycling the majority of the materials and also doing it in a sustainable way.
And have you chosen to enter into joint ventures? One is a means of buying into expertise with your JV partner, but also as a means of finding a partner with deep pockets?
Yeah, for sure. I think historically, we've always had a comfort level with working with partners, and we've even sought them out. We had a joint venture at Mount Marion, which was our upstream lithium mine that we sold out of, and we brought in two very big partners. And we did that because someone else development funded the project, which was nice. And then we also brought in the off-taker into the equation. It meant the mine got built at the appropriate scale and at speed, so that we were actually well past our teething issues before other people were starting commissioning, and that same rationale works for these other projects, looking to expedite with partners who have skills that we don't, but that are complementary to our own skills.
It's quite brave and bold to build plant for people like Mercedes, because if it doesn't work, they're going to find out that it doesn't work pretty quickly. So there's no wiggle room, and you can't sort of hide the flaws, really. So what's your thoughts on that?
First thought is let's not make any errors with Mercedes or others. But no, you're absolutely right. In terms of, I mentioned the pipeline, so you can see Mercedes and Stelco, and there's a third company, a Japanese group called Itoshu, who got an MOU with. But it takes a very long time behind the scenes, diligence. With Mercedes, it took 18 months before we were in a position to announce, the relationship, and there was an MOU for a long time that sat under the radar. And, they, for example, are a particularly exacting customer, and I think most will be. So you can assume if we've got this far, there's some elements to what we're doing that, that do work and make sense to very big companies, and we'll work closely with them. And the idea behind helping them with a pilot facility first is, of course, we need to scale up the refining section as well. We have the benefit of working with them to do that. And then, we roll these out and we make them increasingly larger over time, and the economics just get better and better with economies of scale. But we want to do it gradually in a stepwise fashion, because we don't want to make mistakes, as you say.
Okay, and here we go. My final question. Can I just broadly ask you about funding? You're doing such big projects with big clients, great new innovative business model. How have you funded yourself to this point? How have you filled in the funding gaps?
So we've had for a long time a very strong balance sheet, because we, in several stages, sold down equity in the Mount Marion lithium mine to our partners. We returned a lot of money back to shareholders, some 85 million Australian dollars over the journey. And so, that's given us a strong cash balance to pursue the R&D and the mineral processing technologies which we've developed. Going forward, of course, we're listed, and, one of the reasons for being in a listed environment is having access to pools of liquidity. That's why we listed on that AIM. We didn't raise money at the time, which is probably why, to date we've been under the radar a little bit, because at that point we didn't need it. We wanted to raise awareness about what we were doing. And then going forward, this licensing and royalty model is not by accident. That model itself means that you don't need to pay for the plants. So the CapEx burden, if you like, it's not there. It's not relevant. So going forward, we've got partners, they're co-funding. We're trying to avoid CapEx spend, and then we're listed. So at the point in time that it makes sense to get market support, then of course that's available to us. But I think really the answer is looking to generate, royalty earnings, and then that will support some of these other business units as they too come up through the development curve and get more and more mature.
Jeremy McManus, you're a complete star. Thank you for joining us from Perth, Australia tonight in the middle of the night. That is an absolutely fascinating business model, and extremely well explained. Thank you so much. And here we are, Gaius King, Commodities Analyst, Fox-Davies Capital. The oil price reached $96 a barrel last week, a 10-month high, which is clearly good for producers, bad for global inflation. Depends which side of the equation you're on. Add to that the UK's taxation policy, which is deeply unpopular with North Sea producers. And we thought it was a good moment to take a sector deep dive. So we're joined by Gaius King. He's a commodities analyst from Fox-Davies Capital. He has 30 years of experience working with AIM-ASX and TSX listed stocks. And he's going to give us his insightful commentary on the oil and gas sector. Over to you, Gaius.
Look, I've titled this presentation, for want of a better term, is oil and gas the best investable sector for the coming decade? Obviously, that's a rhetorical question. But a key point that I think has been missed and purposely messed around is if it's not grown, if it's not mined, then you don't have an economy. The mining and oil and gas form the basis of every major economy globally, and there are no exceptions. As Donald alluded to, oil has popped a little bit. I wouldn't say it's been exceptional in the past 6 months, but we would contend that actually this is just the beginning of a major price escalation of oil going into the future, and hopefully we'll demonstrate why. Global oil demand, everyone is predicting, including the IEA, that it will peak around 2028, 2030. We personally believe that it won't peak for decades yet. And here is global oil demand going forward. Obviously, we had a bit of an interruption during COVID, but it's continuing to grow now. It's at all-time highs. And the reason is relatively self-explanatory. Nations which are the largest growth and demand are obviously those nations growing. So the growth in nominal terms was greatest with the US, obviously, because that's already a developed nation. But if you look at the growth rates of China and India, which are shown here at 40% in the last decade, but it doesn't include places like Indonesia, most of Asia, the Middle East, Eurasia. The demand for oil is growing rapidly. And so this is sort of like the analyst's curse. So earlier this year, in a little news article note that we sort of send around semi-weekly, we predicted that there would be oil shortages starting to reoccur third quarter this year. And then, of course, the oil price declined continuously for 8 months, making us out to be barefaced liars. But thankfully, the shortage did occur in the second half of the last quarter. And this quarter, it's going to be larger, at a bit over 3.2, 3.3 million barrels per day. And the global production, nice round number, global production is probably around about consumption production. It's around about 100 million barrels. It's actually a little bit less, about 98, but let's not worry about the little inconsistencies. So there have been supply cuts by OPEC, and Saudi Arabia and Russia suggest they've cut about 1.3 million barrels. You don't see it with Russian oil output, but you have started to see it with Saudi output. But given that output is already 1.8 million barrels short, that gives you a 500,000 barrel shortage per day. But this quarter, even if you take those cuts and even if you assume they are correct, which I don't think they are, there's going to be a minimum of 2 to 3.3 million barrels per day shortage, which can't be satisfied by existing stocks. Just to cover where a lot of the oil comes from, and again, a bit of hubris from an analyst. The biggest story for oil production, obviously, in the last 3 or 4 decades has been the US and oil shale from the US. In fact, in 2010, I think I was working for WH Holland, I produced a note saying that prepare for peak oil, it's just around the corner. And I was getting notes from colleagues saying, look, the USGS have said that there's these massive resources of oil shale in the US that can be tapped. And being the bit of a skeptic I was, I didn't think it was going to ever occur, and how wrong I was. And oil production had jumped from 5 million barrels a day, and it's now, I think, well above 12. But the diagram on the right just proves what's happening, that there was a lot of drilling initially, production came on long, but that drilling has continued to fall for a variety of reasons. Part of it is because there's no longer the amount of land being released to drill. And if we go to the next page, this is the Permian. This is the most productive part of oil shales in the US. And the point is that Permian production has plateaued for 7 years. So if we run into shortages, the US is not going to save us this time round. The US was one out of a box that no one saw coming, or very few people saw coming. I certainly didn't, but it's not coming to rescue. The reason why I don't think Russia is cutting oil production is simply because, you have a look here, Russian oil production has plateaued. In fact, Russian oil production is actually very old. It's very expensive, and it's declining every year, somewhere between 200 and 400,000 barrels a year. A lot of new Russian production which will come online, excluding Eastern Siberia. will require Western technology, which Russia clearly doesn't have at the moment. They tried doing oil shales, but their drilling technology just wasn't up to it. So Russian production is probably going to decline as long as the Ukraine war continues. Let's hope it stops soon. So then the next question becomes, okay, oil production is going to, oil consumption is going to fall because there's going to be this huge arrival of EVs. And we have been non-consensus analysts on this front for at least the last 3 years. We believe that this diagram, let's just jump to this diagram. The two things I just want to point out, this is the EU EV sales. The light blue at the bottom is full battery electric sales. And then the blue here, and these are old figures, these figures are about 6 or 7 months old, there are proprietary numbers. We estimated that 53% of all sales in the EU will be electric vehicles this year, was hybrids. And we've been saying for the last 3 years that hybrids are going to be the big thing, not battery electric vehicles. And the reasons are varied. Battery electric vehicles are chemistry constrained, not technologically. So yes, the batteries can get larger with time, but the range and the rechargeability and a bunch of other factors, you can change the chemistry of these batteries, of course, but they're always going to have limitations. Battery electric vehicles, and a couple of key studies out by Volvo and a couple of others, have proven that battery electric vehicles are structurally more expensive. So they're going to be a large sector of society that will never be able to afford a full battery electric vehicle. That's a fact. And the part of the key thing about hybrids is that the reason why they're outselling everything, and diesel sales are falling and petrol sales are now falling very rapidly, the reason why everyone's jumping for hybrids is that you get a lot of the economic benefits without the shortcomings. And we've said, in fact, the reason why we shorted so many of those American battery electric vehicles is that there were DOA business models. But the other key thing we'll come back to here is that the rise of China and its ability to constrain commodities going into the future, which will be critical. This next diagram we've included a lot of presentations, love it. This is Fifth Avenue, 13 years apart, 1900, 1913. No government mandate did this. People used horse and cart and then decided, in the second diagram, there's only 2 horse and carts there, and they just bought cars. They did it because it was better. And hence this diagram here. And our investment narrative is that the technology is superior and it's more efficient, and it's cheaper, obviously not initially, but eventually becomes cheaper, people will adopt it. And the diagram here might be a bit esoteric, but just to explain it, it took 16 years for 100 million people to have mobile phones. And ChatGPT, which is obviously the AI thing that came out last year, it took 2 months for 100 million people to use that. And there are other technologies that come out since, and it's happened inside of a week. So technological uptake is very quick, it's accelerating, and we would expect that to continue. Okay, getting back to China. Why is China important? Well, China is following, I guess, the business model of Great Britain back in the 18th and 19th century. What it's doing is creating supply chain colonies. It's getting all those resources and feeding back into China, which are refining, processing, manufacturing, value adding. Then they're selling out to the rest of the world. And there's a lot of pink. Pink, when I was growing up, was about the British Empire, and a lot of the British Empire was pink, I remember on the map on school. Now pink means China. And China has the ability to tap very cheap energy sources, basically coal, and it's dominating all sorts of sectors from metals to mobile phones. You can't build an electric car anywhere in the world basically without a Chinese input. And that strength is only going to continue. And what's up against China? And this is the free trade grouping. And it's blue, obviously centered around the US, and it's substantially smaller. I would argue that this region does produce most of the resources that the US needs, but only enough for the US and not enough for Europe. Europe is in the enviable position of legislating battery electric vehicles and their uptake without securing any of the resources. They were very slow in realizing what the game plan was with China. Japan saw it over 15 years ago, and they started diversifying their resources elsewhere. So Europe is in a unique problem, and they are going to have to try and find sources from elsewhere. They don't have colonies. They don't have many friends either. So they used to have Russia, but obviously that's gone away. Why are exports important? Well, if you swap the name for a country for a company, companies to stay alive and be sustainable need to produce a positive outcome. So there you have, in the green, you have China obviously producing a lot of stuff that we want to buy cheaply. You have Russia that actually has a very large manufacturing sector, but produces a lot of raw materials that they now exports primarily to China and India. And actually has just overtaken Germany as being the world's 5th largest economy on a PPP basis. And then at the bottom, on the other end of the ledger, you have the US borrowing huge amounts of money, we don't even know what they're spending it on. And the United Kingdom. Interestingly, India's there as a deficit too, but India is borrowing to build assets, to build infrastructure, and the way they're progressing, and the world's fastest economy growing 7 to 9% per annum, they will be a positive net exporter within a decade. So let's go to the oil and gas industry and try and link these thematics together. The oil and gas industry is incredibly important to the UK. It produces 200,000 jobs, a lot of them very well paying. And back in 1999, when it was at peak production, it was exporting 6 million barrels of oil a day. Now, put that in perspective, that's twice what Russia's exporting at the moment. Just think about it. Russia's the world's 3rd largest exporter, and the UK at its peak was exporting double that. And this is where I jump on the bandwagon a bit. So the current tax rate for oil and gas producers is 30%. For every other company on every other sector, it's 25%. Then just because we could, we chucked another 10% on top, which is fair enough because it's royalties. But recently we added a windfall tax. And my claim here is that it's actually a subterfuge to destroy the native British oil and gas industry. And it's not quite apparent. Yes, the total tax rate is 75%. That's very, very high. And it's created short-term dislocations. Harbour Energy saying their effective tax rate is 102. Obviously, these are temporary. It'll sort that itself out in the long term. Enquest, which is an energy provider, was 118%. But I'd ask the question, what is the difference between Labor and the SNP banning oil extraction from the North Sea and the addition of a windfall tax? In particular, windfall tax, capital ring fencing, which I'll explain in the next page. But firstly, let's see where all these super profits are coming from. So this is BP. BP in 2012, 2014 was producing the same amount of profits that it is producing today in nominal terms. And obviously it had a big gap there where it wasn't producing any profit at all. But the thing is, inflation has jumped by 60%. So if we were comparing like with like, you would expect BP's profits to be 60% higher than it is today, and it's not. And actually, if you go through all the companies, there's very few companies in the UK that are producing super profits that deserve a windfall tax. So then the question then becomes, okay, well, Norway taxes, we charge 75%, but Norway taxes at 78%. And I have to, big shout out to Stefan Bernstein for this. I didn't appreciate the detail on this. I knew it was bad, but I didn't realize how bad. And I'll try and, hopefully I'll be successful in explaining it. If you drill, let's say you drill 4 holes in Norway and you spend $100 million and they all come up barren, at the end of the year, Norway will give you $78 million back. And you can find 22 million from the capital markets and go and drill another 4 holes and hopefully you get success. In the UK, you get no cash back. It's 100% loss. But this is the sting in the tail with this windfall tax that I only recently appreciated. And there's a reason why the oil and gas industry are dead scared that they are facing extinction inside the next 2 or 3 years. So there's this article within oil and gas industry is called ring fencing. Now, as you can imagine, an oil and gas company, a bit like a mining company, they drill everywhere, and a lot of the holes are not successful. But hopefully when you find something, you can claim the expense of those holes back on future production and get that money back, of course. This ring fencing, as far as I can understand, only allows the holes that you drilled in that particular field to be claimed back. Now, you think about the exploration implications of that. It becomes almost automatically impossible to make a profit to become an explorer in the UK. And I just find that utterly, I mean, this is the Tory government that brought it in. So what is the difference between Labor banning it and the Tory government creating a situation where it was completely uneconomic? And I would argue there's no difference at all. Why invest in oil and gas? Well, oil and gas, this is the S&P 500, which has a great number of oil and gas companies. They're doing very, very well. A lot of them are trading on very low PEs and they're producing a heap of cash. In fact, on a global scale, oil and gas is the most attractive, bar none, sector there is out there. You know, Apple and Google are PEs of 30. Nvidia is a P of 108 or 110 or whatever it is. So the technology have massive PEs, but energy companies often, and let's just focus on oil and gas, are on P's of 7, 8, 9. Coal companies are on P's of 3 or 4, by the way, but let's not go there. And these are a couple of examples as of today. So you have ConocoPhillips, they're on a P of 11, they're yielding 4% per annum. Exxon have a slightly better exploration play, growth, P of 9, their yield is 3. But if you look at Woodside, now Woodside is predominantly gas. It's a little bit more variable, but it produces a lot of oil too. Great company. It's on a P of 6 and it has a yield close to 10. There is no company out there in the UK that's even right close to that. Santos, another great company, support the Wallabies. I'm originally, despite my accent, I'm originally from the New Zealand, so I like putting in the knife into the Wallabies anytime I can. But Santos, great company, P 9, yield of 3. And this is the cliffhanger. Because we haven't been investing in oil and gas for the best part of a decade, but they peaked at 2013, global supplies are going to be dramatically short going forward. So by 2030, which, you know, for most people is only 7 years away, production, we are going to be somewhere about 30 million barrels per day short. Now we will find something and it might be a bit more than that, but we haven't found those yet. This, by the way, this source is the Saudi Arabian producer, obviously the world's largest producer, 10% float. So these numbers are not fiction pie in the sky. These are detailed. A lot of analysts in the background have generated this. That 106 target in 2030, I think, will be easily exceeded. That 106 is a little bit higher than IEA. And then the narrative that most people, or the zeitgeist that most people are pushing, is that oil's demand's going to drop off and we'll only need about 106 million barrels, a little bit more than today. But the numbers I'm seeing is that we could easily be 110, 115, 120. That the growth of oil consumption is growing, not exponentially, but very, very quickly. So we're going to be massively short in oil. And if you want to be in a sector that is short, commodity prices are going to go up. This is the one sector to be in. Obviously, there's going to be a bit of variability. And this is my closing slide. Sorry, I rushed this because I ran overtime last time. It's a rhetorical question, obviously. Is the oil and gas industry the best sector to invest in? And I would suggest yes. And I put this diagram here. There is no such thing as a low energy rich country. The narrative that a lot of government departments are pushing is turn off your lights, turn off everything. Factories, we don't need factories. We export them to China. We just buy the stuff back or whatever. That is not a success for economic growth. And unfortunately, it's a Western paradigm that we've been pushing for 3 decades now. And I think it's fundamentally dangerous. It's going to take decades to fix. So go oil and gas.
Okay, thank you, Gaius. So it's going to take us decades to reach peak oil and gas, and that's because economies need oil and gas. Is that the essence of your argument?
Well, that's right. So, I mean, just to take a couple of steps back, our argument at Fox-Davies has been, and we support a great lithium company. There's always
Clean
been
tech
that,
lithium, just for clarity.
clean tech lithium, yes, yes. So we've always promoted the idea that hybrids make a lot of sense because you get a lot of the economic benefits without the material shortcomings, especially in cities. You do need battery electric vehicles. I think if you're in a major city, why not? A battery electric vehicle for short runs, it's great. But so I think the growth and the idea that you could legislate and completely ban all internal combustion engines is a fallacy, and I think that's about to be overturned. It definitely was overturned in Europe. Europe was supposed to ban all internal combustion engines this year, and the EU was just a rubber stamp, and it never happened. Germany, Italy, Poland, Hungary, Bulgaria, and a bunch of others said, no, we're not going to do it. And then the article just died. They gave some sort of excuse that you could build fuels, synthetic fuels, but it's going to be too expensive, and I would expect some rollback in the future. So the growth in other parts of the world that are developing, they're not going to go down that route anyway. They can't. Their electrical systems can't afford it. The other key thing is that a lot of them buying cars, a lot of them are developing very, very quickly. India this year is already larger than the entire UK economy. By 2030, it will be double the UK's economy. So in 7 years, it will be double the UK's economy. And it's developing at an incredible rate. China's obviously slowing down. But, you know, places like Nigeria, Indonesia by 2050 will be somewhere between the 6th and 7th largest economy in the world. So the whole idea of growth is going back to Asia and part of Eurasia, and they're going to use a lot of oil. And the truth is that we don't have the supply. So maybe the supply is so great and the prices become so great that battery electric vehicles become a necessity. I can't see that far ahead. There's too many variables. But oil and gas, I can tell you now, oil and gas is probably not going to fall in the long term much below where we are now. And I was looking at inflation adjusted. And if we go back to 2012, 2013, we're looking at a minimum price long term of $150, $160 a barrel.
Oh, crikey. I'm not sure if that's good news or bad news. It depends which side of the investment you're on, really. Let me put this point to you. Presumably those countries with their own oil and gas resources, Nigeria and so on, and their own tax revenues from that oil and gas will be the last to transition away. So why is the UK the first to transition away when those tax revenues would, well, they're attractive, but if, as per your argument, you kill the oil and gas industry in the North Sea, and then you don't get any of that, why? I'm slightly struggling with it all. Why would you do that to yourself?
You're asking the wrong person. I have no idea. It makes no economic sense. I accept the argument that the UK doesn't have refining here anymore, so it exports the oil somewhere else, and then
it drills it out of the North Sea, and then it sends it off somewhere else to be processed. Yeah,
but that's a nonsensical argument. That's a bit like saying, at the moment, we've banned all Russian oil and diesel. But the dirty truth is, the Russian oil is going to Indian refineries are exploding.
Yeah, and
we're buying a large part of our Russian oil from India. And everyone says, oh no, we're banning Russian oil. So there is no logical reason why you would crush the oil and gas industry here in the UK. And then just from a balance of payments point of view, the UK doesn't manufacture much anymore. It's exported most of that to China and increasingly to India and Vietnam and things like that. So, and we're running 3 to 4% deficits. I think I had a look, in the last 30 years, the UK has only run a surplus of 5 times in the last 30 years. And even more dire, the last government debt in Tony Blair in 2001, I think, was about 32, 33%. Government debt at the moment is about 106%. By 2030, it will be on 130% debt GDP. And then you ask the question, okay, what did we borrow? What did we borrow? And what did we spend all that money on? We spent it on entitlements. And that was the point I was trying to make about India. India are borrowing more than they're exporting at the moment, but they're building huge amounts of infrastructure, housing, factories. They're really going down the chemicals route. They've refused a bunch of Chinese companies like BDY and whatever to establish factories in India because they think, well, no, because then China then controls that production. So India's going down the route of, look, we have to be our own development, our own resources we have to use. India is now actually about to overtake Australia as the world's second largest investor in mines and soon into oil and gas. They weren't even on the list of the 15. Canada, which was the world's largest resource recipient of investment in mining 15, 16 years ago, is now number 7. So the whole world is changing, and China's obviously developing a lot of Africa and importing these resources, and India's desperate to get on the train too. So we've got the great game again, where great powers are chasing smaller countries and smaller areas to get these resources. And obviously we could talk about lithium or rare earths or whatever, but oil and gas is one of those clear resources that everyone's trying to corner.
So final question, I do feel as though in terms of balance, I really ought to ask you about climate change and the need for net zero, and what seems a very laudable drive to net zero. Where does that all fit into this? Where does that all fit into the world as you've outlined?
It doesn't. So just to answer your question with something else I'm working on was about nuclear power. So if you read a lot of the research out there, nuclear power is very expensive and not practical and whatever. So, and a lot of the numbers just look rubbish. I know these are big consultants firms. So I went out and generated the numbers themselves, and I looked at Hinkley C and I looked at Dodger Banks. And I can tell you now, capital intensity, Hinkley C is half the cost of the Dodger Banks standalone rare earth turbine wind farms, half the price for the amount of energy that you get out. And then I created a model where I looked at 2 days in Perth, Western Australia, facing up-to-date CapEx, facing solar panels with a battery technology so you could store for 12 hours a day. That doesn't exist, by the way. And even when I ran through a whole lot of unrealistic assumptions, nuclear power came out about 20% cheaper again. So a lot of the numbers, a lot of the detail we've been given, I think, is a fiction because it's related to, I don't want to say it, it's a nice way to say it, politically, a more politically astute, a GB News way of saying it would be that it's an ideology, almost quasi-religion, but it's not based on economics. It's probably not even based on science.
Where does it come from, though? You think this is a government spin?
I think a large number of people want to believe in net zero without realizing that the amount of metals, just looking at the metals, and I wrote about this last year, the amount of metals you would need to make a net zero contribution, and you got to remember your energy prices can be double from where they are now. It's going to be 300 or 400%. We don't have 300 or 400% more mineral resources to mine to make net zero a reality. So if net zero is not a reality, you have to find energy from somewhere else. My last diagram here is there's no such thing as a low energy rich country. So the UK has lost all its manufacturing, all its resource. It's about to lose all its last steel. It's lost its mining, refining. And when you lose those sectors, it's a technological ecosystem and you lose the ability to gain from research. So any new research into electric cars, and you can see this with China now, China builds, with the exception of Tesla, China builds the best electric cars in the world. They've surpassed Germany. And because they build so many cars now, the quality control of a Chinese car is now matching the average quality control and surpassing the quality control of a German-made car because they're building so many and they have so many engineers. And so any technological developments in these new areas moving forward, you're not going to participate in because you don't have any investment in. So that's a very, very real danger that we're just becoming consumers and we're not making anything on net value. And I can't see a system where we don't continually run deficits.
Okay, Gaius King, thank you so much. That was absolutely fascinating. Quite controversial, but absolutely fascinating. Always good to hear a different point of view. Gaius King, Commodities Analyst at Fox-Davies Capital, thank you so much for joining us this evening. And that's it for us after another great investor evening. Thank you very much indeed to all our speakers for joining us live from around the world, and to their support teams for getting them there. And many thanks to everyone from London South East, from focusIR and London Broadcast Studios, who always do such a terrific job getting us here. And that's it from me. Huge thanks to you all once again for being such a great audience. And we look forward to seeing you again on November the 7th when we host our next IR webinar. Have a good evening, everyone.